Hello and good morning, listeners. Welcome back to Almus Market Mornings with me, Shikhar Garg, as we begin the last month of the year 2022. Some good updates to begin with is a better than expected GDP number for India, around 6.3% as against the expected 6.2%. This is something really awaited for the Indian markets. Other than that, we had Mr. Powell's speech yesterday, and although for the most part of the speech it was quite hawkish, yet the closing statements were the ones which brought in kind of rejoice in the markets, as Mr. Powell mentioned that there's a possibility of moderation in the pace. This led to USD JPY breaking multi-week low of 137.6 and trading below that. We've seen Euro and others rallying as well. So, JK, I'd like to know whether this pace of rate hikes is that something we should be focusing, or whether where does this hiking session ends is what should be looking for.
Hey, good morning. Actually, markets have been rejoicing the combination of inflation rates coming down across countries and perhaps some dovish tilt in Powell's speech yesterday. And in fact, Jayaram Powell boosted market expectation of a downshift in the rates in December 13-14 meeting. Actually, for most part, as you said, the Powell speech was on the hawkish side, saying and pointing to the strength of the labor market, and more evidence was needed to give comfort that inflation was actually declining. He even cautioned against prematurely loosening the policy. But what market took heart from was that, when he said time for Fed to moderate pace of rate hikes could come as soon as the December meeting, and the policy had made substantial progress towards a sufficiently restrictive setting, and that October inflation data was a welcome surprise. He also said he did not want to over-tighten. This was a classic sell rumor buy fact action by the market. And once his statements are out, markets also said there's nothing new to read as far as hawkishness is concerned, and it triggered bulls into action, lapping up stocks and bonds in hordes. The debate among analysts now is whether Powell is a hawkish dove or a dovish hawk. Of course, market's dovish interpretation and positive action was also triggered by other global signs of inflation easing and data points from US which showed softness. Eurozone inflation following an Australian inflation dropped from 10.6 to 10 as per flash estimates, though mainly it's on energy development. While the absolute inflation rate is still very high in Europe, the tentative signs that we are close to a peak are actually increasing. Other data points in the US were giving comfort to the markets. Hiring showed, rather the private hiring in November showed a drop to 1,27,000 versus 2,39,000. Expectation was 2 lakhs. In a massive downside surprise, Chicago PMI just printed 37.2 versus 47 expected, and plunging to its lowest level since the peak of the COVID lockdowns. This was below lowest estimate of 25 economists surveyed. And just to note, in 55 years, this level of Chicago PMI has never failed to coincide with a recession. Jolt's data showed job openings dropping to 10.3 million from 10.7 in October, and that was also as expected. And there were about 1.7 job openings for each job seeker in October, down from 1.9 in September. So it's depicting a moderation in the mismatch of demand and supply of labor, which should give some relief to the Fed, who have been pointing to tightness in the jobs market. Pending home sales dropped. The index dropped to 88.9 from a downwardly revised 91.5 in September. So market had actually expected a fall, but only to a level of 18.5. The only good news in US was the GDP for third quarter, which came at 2.9% versus market expecting 2.6%, and with upward revisions to consumer spending and imports being revised down. So by the time markets had heard, Powell, we already had a slew of weak reports, and that was a perfect setting for a rally, which was really breathtaking. Nasdaq rose a whopping 4.41%, and in the process went above the 200 DMA. Dow rallied 2.09%, recording a recovery of more than 20% from the lows hit in September. Bonds found enough buyers and yields dropped 10-year yield dropping to weeks low of 3.6%. Even the 2-year fell by nearly 25 basis points, a reflection that the market is trying to price in lower terminal rate. In fact, the expectation as per market watch is the rate to peak at 4.95% in May, compared with expectation of 5.06 that was priced earlier in the day. Turnaround in the dollar was really telling. Dollar had been up as much as 0.3% earlier, but ended nearly 1.5% lower from the highs. Yen and yuan have been the biggest gainers, with 2.3% and 1.8% gains, respectively, while euro and GBP have been testing their previous recovery highs. The tailwind from a stronger yuan has seen Aussie and New Zealand dollar outperform with 1.3 and 1.4%, and the Canadian dollar, which had been hit down to 1.3645 on the back of the M&A deal, recovered to 1.34. The dollar index itself has been testing the 200 EMA again, likely to hold for now, but the upcoming economic data like the CPE core inflation today, the PCE core inflation today and the jobs data tomorrow can trigger a break there. Asian currencies have recovered very smartly, with the Korean won and Malaysian ringgit standing out with 9 and 8% gain respectively in the last 1 week. While Asians can consolidate these big gains, a break in CNS through 700 at the psychological point can trigger further large gains. I expect yuan, rather the Chinese authorities, to resist larger gains for the yuan, keeping in mind the weakness of the economy. The focus obviously now shifts to PCE core inflation from US tonight, and estimates point to a fall in both the month-on-month and year-on-year numbers. This can add to the bearishness in dollar and bullishness in stocks and bonds. Additional focus will be on the ISM manufacturing data today and the monthly jobs tomorrow. Coming to our own markets, yes, the GDP at 6.8% was 6.3% was almost in line with the market's expectation. The details show that the agriculture sector did very well, while the manufacturing sector really slowed down. In fact, the core sector output, another data came much lower from the previous month, mainly because of the challenges in the energy sector. Now, the moves in the global markets definitely will have a spillover effect on the rupee, and I feel the near-term outlook for the rupee is definitely positive, taking cue from the massive drop in dollar index and also the dollar's drop against the Asian currencies like Korean won and the Chinese won in the last 3 days. Added boost to the rupee has been the resumption of inflows, which was close to 6 billion in November, with yesterday alone accounting for more than 1 billion. Technical development on the charts for the rupee, prices closing below 81.44, which was the previous correction low. Rally from 80.40, seen in the wake of previous fall in the dollar index, has failed to make a new high, and prices returned without touching 82. And on a monthly basis, which is important in my view, prices closed below the opening levels of the previous month. This is the first time this has happened after 10 months of relentless rise in the USD-INR. So all these indicate to me that the weak uptrend in the USD-INR has weakened, and we can expect further losses for the dollar in the coming days. And I cannot rule out a test of some below 80.40 in the coming weeks. Thank you.
Quite an interesting update, JK, and quite thorough update, I must say. I mean, the kind of things that are going on in the financial market, as we see from the Powell speech, where he mentioned the caution about a premature loosening of policy, as well as in some form and fashion advising that the possible moderation in the pace is there. At the same time, Eurozone, Australian nation, as well as a lot many other nations are posting softer numbers when it comes to inflation. But what was seen was the whopping recoveries in the equities after the Powell speech. I mean, that was something quite substantial. On the Asian side as well, I see, JK, as you mentioned, a break of 7.00 handle for CNH can be quite significant. And as we have been talking about USD INR, it is quite brilliant to see, and how you shared that the already ongoing uptrend for USD INR has shown some sort of moderation or stopping after 10 months of constant rise on monthly basis, and the November month being the first one. And who wouldn't enjoy a good inflows from the FIIs in the equity markets? I mean, more than 1 billion of flows yesterday itself. It's quite significant, folks. So things are changing a bit. Let's see how the financial markets react to a lot of many things to come forward. Uh, this is it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.
Just pointing to really good news from the World Bank from the rupees perspective. The remittances in 2022 grew 5% despite the global headwinds. And in 2022, for the first time, and in a single country, India is on track to receive more than 100 billion in yearly remittances. And that should really warm the hearts of rupee bulls. Thank you.
Oh, wonderful. 100 billion of worth of remittances. That's quite a significant number. And I think we've not seen something like this in years. So, kudos, folks. That's that for today. And it's a really good time coming in. Hopefully, at least from the weather wise, I hope you guys enjoy it. Thank you so much for listening.